Welcome to the Deep Dive. Today we are dedicating our entire focus to unpacking this phenomenal text we have called The Architecture of Credit: Mastery Over Modern Debt.
It is a brilliant piece of source material, truly.
It really is, and we are focusing entirely on this little plastic or, metal object sitting in almost everyone's pocket right now.
Yeah.
But I want to set the ground rules for you, the listener, immediately. This is not like a lecture on frugality.
Right, no finger wagging today.
Exactly. We are not here to tell you to cut up your cards or freeze them in a block of ice or whatever. Our mission today is pure decoding.
And that decoding is so necessary because the system is intentionally designed to be frictionless. I mean, the interface is incredibly simple, right? You tap a terminal, a little green check mark appears, it beeps, you take your coffee, and you leave.
Seamless.
Totally seamless. But beneath that frictionless surface is this meticulously engineered labyrinth. It is full of rules, timing mechanisms, algorithmic risk models, and honestly, behavioral traps.
I always think of it like renting a commercial-grade lathe or like a really high-end power tool.
Oh, I like that analogy.
Yeah, because if you walk into a workshop and you understand exactly how the safety guards function and where the emergency stop is and, the physics of the torque, you can build incredible things. It gives you unbelievable leverage.
Absolutely. Unmatched leverage.
But if you just plug it in, close your eyes, and start mashing buttons just because the machine looks shiny and makes a cool noise, the consequences are going to be immediate and severe because the machine doesn't care about your intentions, right?
Right.
It just executes its engineering.
That is a highly accurate framework for how the architecture of credit approaches this whole subject. In fact, the text demands a fundamental shift in definition before it even begins analyzing the mechanics.
Right. It forces you to redefine what you are holding.
Exactly. The core issue is that when a consumer opens an envelope in the mail and they pull out a piece of plastic with, let's say, a $15,000 limit, their brain intuitively categorizes that as new wealth.
Like they just got a raise.
Yes, it feels like an expansion of their available resources.
So let's stop right there and just dismantle that illusion completely. Because a credit card is not extra income. It is never extra income. It is exclusively a short-term unsecured loan, period.
100%.
I mean, if you use a debit card, you are settling a transaction with your own past labor.
Yeah.
The money is yours. It is in your checking account. The trade is finished right then and there. But when you swipe a credit card, you are deploying the bank's capital.
You are playing with their money.
Right. The bank pays the merchant, and you instantly, like in a millisecond, enter into a legally binding contract to reimburse the bank at a later date under a very, very specific set of conditions.
And those conditions are exactly what we need to examine first, because the source material actually breaks down the literal rule book of this short-term loan into a trio of foundational mechanics.
The three pillars.
The three pillars, exactly. And understanding these three pillars is the equivalent of learning where those safety switches are on your power tool. If you misinterpret even one of them, the entire financial advantage of the system just collapses.
So let's test the architecture then. The first pillar the text identifies is the credit limit. Now, obviously on the surface, this is just the maximum amount you can spend. But you mentioned earlier that it shouldn't be viewed as a pool of money. So how does the bank actually define that number? Because I have to be honest, it always feels slightly arbitrary to me. Like sometimes they offer $5,000, sometimes $20,000.
Oh, I assure you, it is the furthest thing from arbitrary. The text defines the credit limit as a quantified trust metric.
A trust metric.
Yeah, it is a pure algorithmic output. When an issuing bank offers you a $10,000 limit, they haven't just thrown a dart at a board. They have run your income, your historical repayment behavior, the length of your credit history, and all your current debt obligations through a highly complex risk model.
So they're stalking my financial past, essentially.
Basically, yes. And that $10,000 is the precise threshold at which their statistical models predict you are most likely to manage the debt without defaulting, while, and this is key, simultaneously giving you enough rope to potentially carry a balance and generate interest for them.
Oh, wow. That is a really crucial distinction. So it's not the amount they think you can comfortably pay off every month. It's the absolute maximum risk exposure they are willing to take on you as an individual entity, like a boundary wall.
Correct. It is a strict ceiling of risk. And once that ceiling is established, the bank implements the second foundational mechanic to track your behavior within that space, and that is the billing cycle.
I have always found the billing cycle mechanism super fascinating because it feels like this weird relic of the past that banks have perfectly adapted for the modern digital era. Like, they aren't treating every single coffee purchase as a discrete individual loan that needs to be paid back by next Tuesday.
Right, that would be an administrative nightmare. So they aggregate the data. The billing cycle is essentially just a recording window, usually spanning, say, 28 to 31 days.
Just keeping a running tally.
Exactly. During this window, the bank simply acts as a silent ledger. Every time you tap your phone for a subway ride, every time you book a flight, the bank just adds a line item. They are batching your microloans.
Okay, so they just let it pile up.
Yep. And then at the end of that 28 to 31 day period, the window abruptly closes. The bank snaps a photograph of the ledger, they tally up the total amount of their capital that you deployed, and they generate your statement.
And I feel like the moment that statement is generated, the dynamic entirely shifts. The passive, friendly recording phase ends and the active collection clock begins.
The timer starts ticking.
It does. Which brings us to the third mechanic, the due date and the grace period. And this is really where the tension lies in the whole system.
Oh, this is the absolute fulcrum of the entire credit card industry. See, when the billing cycle closes, the bank doesn't aggressively demand payment the very next morning. The source details how regulations and just general industry standards provide a buffer.
The grace period.
The grace period, exactly, which is typically 20 to 25 days after the statement closing date. And that final day of the grace period is your actual due date.
Okay, I really want to slow down here, because this 20 to 25 day window is essentially the most powerful financial shield available to a consumer. The architecture of credit heavily emphasizes that if you understand the grace period, the card operates as a flawless, entirely free payment mechanism.
It is an extraordinary benefit when you utilize it correctly. I mean, just think about the timeline here. Let's say you make a massive purchase on the very first day of your new billing cycle. It takes 30 days for that cycle to close, right?
Right.
And then you have another 25 days after that before the bill is actually due. You have effectively secured an unsecured loan for nearly 2 months. And if you pay the aggregated statement balance in full before that due date, the bank does not charge you a single fraction of a cent in interest.
It's wild when you think about it like that. You used their money, you probably collected some rewards points, you enjoyed all the consumer protection, and you paid zero capital costs.
Nothing. It was a free float.
But, and this is a massive but, there is a highly sensitive tripwire hidden in this mechanism. The text is incredibly stark about the conditions required to maintain that shield. It is not, it's not a sliding scale, is it?
Not at all. It is entirely binary. The grace period only exists. It is only activated if the statement balance is paid in full. 100%. Every single penny.
Okay, let me push back on that just to make sure the mechanics are perfectly clear for you, the listener. Let's say my statement balance for the month is exactly $2,000.
Okay.
I am a responsible person, but cash is just a little tight this week, so I pay $1,950.
Okay, so you leave $50.
Right. I leave just $50 unpaid on the due date.
Yeah.
Does the bank just charge me a tiny proportional bit of interest on that $50? Like a few cents?
No. And this is exactly where millions of consumers get completely blindsided by the math. If you do not pay the statement balance in absolute full, the grace period completely
It
shatters.
just breaks.
It shatters into a million pieces. You have breached the core condition of the interest-free loan. Depending on the precise terms of your specific card, the bank will now assess interest. And crucially, and this is the part that shocks people, they do not just assess interest on the $50 you left behind.
Wait, really?
Really, in many cases, because the grace period was avoided, interest is calculated based on the average daily balance of the entire billing cycle.
Wait. So because I left $50 unpaid, I could be charged interest retroactively on the $1,950 that I already paid back.
Yes.
That is brutal.
It is brutal, but it's the contract. Because the underlying agreement basically says, we will waive all interest fees if and only if the balance is settled entirely. By leaving even a $50 balance, you convert the entire month's activity from an interest-free float into a standard interest-bearing debt instrument. You are now officially carrying a balance, the shield is gone, and you are fully exposed to the bank's profit engine.
Wow. That completely recontextualizes the danger. It isn't just about paying most of your bill. I mean, the architecture demands absolute compliance, or it penalizes you on the macro level,
It is an all-or-nothing game.
which perfectly bridges us into how the issuers actually generate their revenue.
Yeah.
Because once that grace period drops, we enter this landscape of compounding math that is specifically engineered to be highly lucrative for the bank.
The transition is totally seamless. You move instantly from being an unprofitable transactor, which is what they call someone who pays in full, to a highly profitable revolver. And the source text actually breaks down the issuer's revenue model into multiple distinct streams, which really proves that this isn't just some simple loan business.
It's an ecosystem.
It is a highly diversified, multi-tiered economic engine.
So let's start with the heaviest hitter then, which, as we just established, only kicks in when the grace period is broken. And that is interest income. Now, obviously, most people know credit cards have high interest rates, but the text forces us to look at the actual mechanism of how that interest is applied. We aren't talking about a simple, like a flat annual fee here.
Oh no, we are talking about compounding daily periodic rates. The source highlights that credit card interest is typically expressed as an annual percentage rate, or APR, right? And that often hovers between, say, 24 to 36% in today's environment.
Which is already high.
It's astronomically high, but the bank doesn't wait a whole year to charge you that 24%. They take that APR, they divide it by 365, and they find your daily periodic rate. And every single day that you carry a balance, they multiply your balance by that daily rate and they add it to your total.
So if I carry a balance, the amount I owe literally increases slightly while I am asleep. And then the next night, the interest is calculated on the new, slightly larger balance. So I am paying interest on the interest.
That is the very essence of compounding. It builds on itself. To put those rates in perspective, I mean, if you walked into a traditional bank branch today and sat down with a loan officer and asked for a personal loan or a mortgage at 28% interest, you would be escorted off the premises.
They would think you were insane.
They would. It is a predatory cost of capital in any other context. Yet, because the friction of the swipe is so low, consumers just willingly accept a 28% compounding loan on a piece of plastic for something as trivial as, like, a Tuesday night restaurant dinner.
Which means the dinner you ate 3 months ago, if you didn't pay it off completely, is still sitting on your ledger, actively generating literal pennies of profit for the bank every 24 hours.
Every single day.
Okay, but interest is only the first pillar of their revenue. What happens when a consumer doesn't just carry a balance, but completely misses the timing mechanics entirely? Like, they just forget to pay.
Then you trigger the second revenue stream, which the text categorizes as the volume play, and that is late fees.
Now, an individual might look at, a $35 or $40 late fee and think, okay, whatever, I forgot what day it was. I paid a stupid tax. It's annoying, but it's not the end of the world.
Right. On a micro level, it is a relatively minor penalty. But remember, the bank operates purely on the macro level. They are managing a portfolio of tens of millions of accounts. They possess literally decades of behavioral data. So they know with absolute statistical certainty that a specific, highly predictable percentage of their user base will miss their payment by 1 and 2 days every single month.
Just mathematically guaranteed.
Guaranteed. Whether due to disorganization or maybe unexpected emergencies or just simple human forgetfulness.
So that $35 penalty isn't just a punishment for being bad at calendars. When multiplied by, say, 3 million minor human errors across the country in a single month, it becomes this structural $100 million revenue pillar.
Exactly. It is entirely baked into their quarterly earnings projections on Wall Street. They rely on the statistical guarantee of human fallibility.
That is wild.
But here's the thing. Both of those streams, interest and late fees, they rely on the consumer making a mistake, right? They rely on you carrying a balance or missing a deadline.
Right. And this is exactly where my own understanding of the system got completely upended by the source material. Yeah, because I always assumed the banks only made money off the people who messed up. I thought that if I paid my balance in full every single month, never paid a cent of interest and never paid a late fee, I was essentially a free rider, like I was beating the bank at their own game.
A lot of people think that.
But the text reveals a third revenue stream that operates entirely independently of consumer debt.
Yes, the invisible cut. Stream number 3. Interchange fees, which are also known as merchant discount fees. And this is the exact mechanism responsible for that wealth transfer we discussed at the very beginning of this deep dive, at the coffee shop.
Okay, please explain the plumbing of this, because it all happens in literally milliseconds. When I swipe my card for, let's say, a $100 pair of shoes, what actually happens between the little terminal and the bank?
Okay, so when the terminal reads your card, this highly complex routing process begins instantly. The merchant's bank talks to the payment network, typically a massive duopoly like Visa or MasterCard, which then talks to your issuing bank.
Right, checking if I have the funds.
Exactly. The issuing bank confirms you have the available credit, and they approve the transaction. But here is the massive catch. Your issuing bank does not send the shoe store $100.
They intercept a toll.
They do. They send the merchant, say, $97.50. The remaining $2.50 is intercepted and split between the payment network and your issuing bank. That percentage, which is usually between 1.5% and 3.5%, depending on if it's a basic card or a premium metal card, is the interchange fee. And the merchant absorbs that loss on every single credit transaction they process.
But why? Why on earth would a merchant voluntarily agree to lose 3% of their top-line revenue? I mean, in a lot of retail sectors, profit margins are razor thin to begin with. Giving up 3% just seems financially suicidal.
It does seem that way. But it is a captive system, fueled entirely by network effects. The merchants accept the fee because they mathematically have to.
They don't have a choice.
None at all. If a prominent shoe store decides, you know what, I'm going to stop accepting major credit cards to save that 3%, they won't just lose 3% of their margin. They'll lose 60% of their total sales volume overnight because consumers demand the convenience and they demand their rewards points. The payment networks have created a product so completely ubiquitous that rejecting it is economic exile for a retailer.
But the merchants don't just quietly absorb that loss and let their businesses go bankrupt. They're irrational actors. They compensate.
Exactly. They compensate by universally raising the retail price of all their goods. So the cost of the shoe is artificially increased to, say, $103, just to bake in the hidden tax of the payment network.
Which brings us right back to the coffee shop example from the intro.
Yeah.
The retail price is inflated for everyone to cover the interchange fees. But only the person using the Premium Rewards credit card gets a fraction of that inflated price handed back to them in the form of points or cash back.
Exactly.
So the person paying with physical cash, or just a basic debit card, pays the inflated price but receives absolutely no rebate. They are actively subsidizing the rewards ecosystem of the credit user.
It is a highly regressive systemic tax. And for the issuing bank, it is guaranteed zero risk revenue. Because whether you pay your bill on time or whether you default on your debt completely, the bank secured their 2% cut the literal second the merchant's terminal beeped.
It is a genuinely brilliant piece of financial engineering. Terrifying, but brilliant.
Oh, without a doubt.
But the banks don't even stop there. The text outlines a fourth stream, which operates almost like a trapdoor for desperate consumers. Cash advances.
Yes. This is where the architecture becomes aggressively, almost vindictively punitive. If you take your credit card to an ATM and you withdraw physical currency, the bank reclassifies the entire nature of the transaction. You are no longer purchasing good on their network. You are extracting raw liquidity from their reserves.
And all the normal safety guards are instantly removed.
Instantly. Gone. First, there is almost always an upfront transaction fee, often 5% of the total withdrawal amount, charged the literal second the cash dispenses from the machine. Second, the interest rate applied to cash advances is significantly higher than your standard purchase APR.
So if my purchase APR is 24, my cash advance might be what, 29?
Easily. Sometimes higher. And the most dangerous part of all, the grace period does not exist for cash advances.
Wait, not at all.
It is nullified completely. There is zero interest free float. The compounding daily interest clock starts ticking the exact millisecond the ATM spits out those bills. It is the most expensive, most highly penalized action a consumer can possibly take within the credit ecosystem.
Man. And then you add in all the other hidden tripwires, right? Like foreign transaction fees that just skim 3% off every purchase you make abroad, or annual fees that charge you hundreds of dollars a year just for the privilege of holding the physical plastic in your wallet.
Yeah.
And the sheer density of this profit engine just becomes totally overwhelming.
It is an absolute fortress of revenue.
Which naturally forces a behavioral question. Because if you are listening to this and you realize the system is rigged with compounding interest, punitive late fees, invisible taxes, and aggressive cash advance traps,
Yeah.
why do millions of people continually swipe their way into crushing, life-altering debt? I mean, are people just inherently bad at math?
No, it is not a failure of mathematics at all. It is a fundamental vulnerability of human psychology. And the text actually dedicates its entire third section to exactly this, to the psychology of the swipe. It acknowledges that banks are not merely building financial products, they are actively exploiting well-documented neurological pathways.
So let's break down how the brain interprets spending, because the text argues there is a core fundamental difference between parting with physical cash and interacting with a digital interface.
Right. It centers on a concept called the friction of spending. Behavioral economists and neuroscientists have studied this extensively. When you purchase an item with physical cash, your brain registers an immediate, tangible loss.
Like a real-world loss.
Exactly. If you hand over 5 crisp $100 bills to a cashier, your wallet is physically lighter. You visually see the resources leaving your possession. And functional MRI scans actually show that paying with cash activates the literal pain centers in the human brain. It physically hurts to hand over cash.
But the credit card completely bypasses that pain center through what the text calls psychological delay.
Yes. The credit card miraculously decouples the joy of acquisition from the pain of payment. You get the huge dopamine hit of walking out of the electronics store with the new television today, but you do not surrender any actual resources today.
Right, your checking account balance doesn't drop by a single cent.
Not a penny. The pain is entirely deferred, maybe 30 to 50 days into the future.
And by the time the statement actually arrives a month later, the thrill of the television has completely faded. It's just, a screen sitting in your living room now. The dopamine is gone. And you are left only with the cold, hard resentment of the bill. You are essentially paying for a past version of yourself.
Which is deeply unsatisfying. Furthermore, it isn't just the delay that tricks us, it is the physical nature of the transaction itself. The source highlights the invisible money effect. Tapping a smooth plastic card, or worse, just waving a smartwatch near a glowing terminal, does not register neurologically as a transfer of wealth.
It just feels like a magic wand.
It registers as a digital handshake. You trade a little electronic beep for a latte. This abstraction artificially suppresses our awareness of our diminishing resources. We just do not feel poorer after a swipe.
Which creates the perfect, frictionless psychological environment for the absolute most devastating trap in the entire architecture. The minimum payment.
Oh, the minimum payment, the ultimate illusion.
I really want to spend some time on this because the minimum payment is presented to the consumer as a lifeline. It looks like a gesture of goodwill from the bank. Your bill arrives and it says you owe, let's say, $2,000. And that big number induces instant anxiety. But right beneath it, in a highly visible, usually bolded box, is a much smaller, far more comforting number. Minimum payment due, $45.
That framing is highly, highly intentional. By presenting a fractional payment, which is often calculated as just 1 or 2% of the total balance plus interest, the bank anchors your psychological expectation. It literally whispers to your anxious brain, hey, do not worry about the $2,000 right now. We are reasonable. Just give us $45 to show good faith, and you are entirely compliant.
It's an incredibly effective pressure release valve. The consumer pays the $45, they feel a legitimate sense of accomplishment for meeting their obligation for the month, and they go to sleep completely unaware that they just actively elected to step onto a financial treadmill that is continually speeding up.
Because the math of the minimum payment is explicitly designed to maximize the lifespan of the debt. Let's actually walk through the mechanics of how a balance revolves, just to make it real. Let's say you have that $2,000 balance at a standard 24% APR. You make the $45 minimum payment, okay? Your balance drops to $1,955.
But the grace period is dead.
Exactly, the shield is down. So over the next 30 days, the bank applies the 24% compounding interest to that $1,955. They add roughly $40 in new interest charges over the course of the month, so your balance is right back up to $1,995.
Wait, so you paid $45, but you only reduced your actual principal debt by $5.
Just $5.
That is sickening. And that scenario assumes the consumer literally stops living. It assumes they freeze the card in a block of ice and never buy groceries or gas again. But in reality, life continues. People have to eat.
That is the crux of the trap. The consumer still needs to function in modern society. So the next month they put, say, $300 of normal, necessary, everyday expenses on the card. Now their balance is almost $2,300. The interest now compounds on the new, larger number. The new minimum payment creeps up to maybe $55.
And if you continually add new, necessary life expenses to the card while only paying the minimum, The mathematical reality dictates that the balance will never, ever reach zero.
Mathematically impossible.
You are effectively walking up a down escalator. As long as you keep walking, you feel like you're moving, but the machinery is pulling you backward faster than you can physically climb.
The industry term for this is revolving credit debt. You are no longer utilizing a payment tool. You are servicing a permanent compounding liability. And the descent into this state is rarely a sudden, dramatic collapse. It's not like you go bankrupt overnight. It is a slow, very comfortable slide, facilitated entirely by the illusion that making the minimum payment equates to being a financially responsible adult.
And here is where the architecture reaches far, far beyond the walls of the issuing bank. Because if you get caught on that escalator, the consequences don't just sit quietly on your monthly statement. They leak out. They infect your entire financial identity, which transitions us into the macro consequences outlined in the text, the ripple effect, and the credit score ecosystem.
This is a vital conceptual leap for anyone listening. Everything we have discussed so far, the interest rates, the late fees, the grace periods, is a bilateral agreement. It's just between you and one specific bank. But hovering above all of this, in the background, is a third-party surveillance layer, the credit bureaus.
Equifax, Experian, TransUnion, the all-seeing eyes that just constantly aggregate your behavior.
They monitor absolutely everything, and the text isolates one specific metric they track that profoundly confuses even highly educated consumers, and that is credit utilization.
Okay, let's define the actual formula first before we talk about why it's so incredibly dangerous.
The formula itself is straightforward. Credit utilization is the ratio of your current outstanding balance compared to your total available credit limit.
Simple division.
Simple division. If your bank issued you a $5,000 limit and your statement closes with a $4,000 balance, your utilization ratio is 80%. You are actively utilizing 80% of the trust the bank extended to you.
Now see, logic would dictate that if the bank gave me a $5,000 limit, they are explicitly telling me it is completely safe and permitted to spend up to $5,000. As long as I don't go over the limit and as long as I pay my bill on time, I'm following the rules, right?
That is the logical assumption, and it is entirely demonstrably wrong. The text details what is known in the industry as the 30% rule. And this rule exposes how algorithmic risk models actually perceive human behavior, which is very different from how we perceive ourselves.
Okay, break that down.
Let's imagine a scenario. You have that $5,000 limit. You put $4,500 on the card this month, but you are wealthy or you just have great cash flow, and you pay the entire $4,500 off before the due date. You pay zero interest. You might assume the algorithm views you as a flawless, highly lucrative, perfect customer.
Right, because I paid it all back. I proved I'm good for it.
But the algorithm is looking at a static snapshot in time. Exactly. When the billing cycle closes and the bank reports your $4,500 balance to the bureaus, the algorithm sees a 90% utilization rate. It doesn't know you are going to pay it off in full next week. It doesn't care. It only knows that right now, at this exact millisecond, you have nearly maxed out your available credit line.
And how does a faceless risk model interpret a maxed out credit line?
It interprets it as a glaring distress signal. To the algorithmic models, a consumer operating at 90% utilization is a consumer who fundamentally lacks cash flow. It suggests you are heavily reliant on borrowed capital just to survive the month. The statistical probability is that a consumer running at 90% utilization has absolutely no financial shock absorber. If their transmission breaks or if they face a medical emergency, the model assumes they will immediately default on the debt.
So even though you are paying perfectly on time, the system penalizes you for appearing desperate. It is deeply, deeply counterintuitive. You are actively punished for utilizing the exact capacity the bank explicitly offered you in the first place.
Which is precisely why the source material aggressively stresses the 30% rule. To maintain a healthy algorithmic profile, a consumer must never allow their reported statement balance to exceed 30% of their total limit. So if you have a $5,000 limit, your reported balance should never ever cross $1,500.
But wait, if I naturally need to spend $3,000 a month on regular expenses like groceries, gas, utilities, and I want to get the rewards points for that spending, how do I keep my utilization under $1,500 without just reverting to physical cash?
You have to manipulate the reporting mechanics. The text outlines two main methods. First, you just request a massive credit limit increase. If you can get the bank to raise your total limit to $10,000, while that same $3,000 in monthly spending suddenly drops to a perfectly healthy 30% utilization. You dilute the ratio by expanding the denominator.
Right, you just make the pool bigger so your splash looks smaller. But what if the bank won't increase my limit? Because my credit is already, a bit damaged.
Then you manipulate the numerator. You do not wait for the billing cycle to close. You log into your account mid-month and you make a preemptive payment.
Oh, interesting.
Yeah. If you spend $1,500 in the first 2 weeks, you pay it off immediately. Then you spend another $1,500 over the next 2 weeks. By the time the cycle officially closes and snaps that photograph to report to the bureaus, your balance appears beautifully low. You artificially suppress the data the algorithm sees.
Which requires an incredibly proactive, almost paranoid level of financial management. I mean, you're constantly logging in. But it is necessary because that utilization ratio heavily influences the output of the entire system. And that output is the 3-digit credit score.
Yes, the almighty score.
And I really want to pause here and ground this abstract concept in reality. Because it is very, very easy to treat a credit score like a gamified metric on a smartphone app. You log in, you see a 680 or 740, a little digital confetti pops on the screen, and you close the app. It feels divorced from reality. But this 3-digit number is the invisible gatekeeper to modern society.
It truly is. It is the defining metric of your economic mobility.
It dictates entirely tangible life events for you. Let's talk about housing, for example. If you want to rent an apartment in any major city, property management companies don't just check your income anymore, they pull your credit score. A low score doesn't just mean a higher security deposit. It often means a flat denial. You cannot live there.
Or consider auto loans. Let's say 2 individuals walk into a dealership to buy the exact same $30,000 vehicle. Person A has a pristine 780 credit score. The bank offers them a 4% interest rate. Now, person B, who missed a few minimum payments back in college and currently carries high utilization, has a 620 score. The bank views them as a subprime risk and offers them an 11% interest rate. Over a standard 60-month loan, person B will pay thousands and thousands of dollars more in raw interest for the exact same vertical piece of metal.
The exact same car.
Identical car, different price.
The macroeconomic reality is that a poor credit score doesn't just prevent you from accessing, fancy luxury credit cards. It acts as an invisible, punishing tax on your basic existence. Mortgages become completely inaccessible, blocking the primary vehicle for generational wealth building. In some states, even auto insurance providers use credit-based insurance scores to determine your monthly premiums.
Yes, operating under the statistical assumption that poor credit correlates with higher driving risk. It touches everything.
It's pervasive. If you mismanage the mechanics of that little plastic card, you risk total financial exile. You are forced into the fringes of the shadow banking system, payday loans, predatory lending, where the cost of capital is truly catastrophic.
It becomes a completely different reality.
So, okay, if we stop the analysis right here,
Yeah.
the picture we have painted is incredibly bleak. We have a system built on compounding interest traps, hidden macro taxes on merchants, behavioral exploitation of the human brain, and algorithmic surveillance that can make your life exponentially more expensive. I mean, a listener would be entirely justified in concluding that credit cards are inherently predatory, malicious instruments designed to just extract wealth from the working class.
Oh, absolutely. It is a highly rational conclusion based on the trapdoors alone, but the architecture of credit executes a very sharp, very deliberate pivot in its final chapters. The thesis of the text is not that the system is evil.
Right.
The thesis is that the system is exceptionally powerful, and power is completely agnostic. It just depends on who is holding on the tool.
Which moves us into the silver lining. The argument that there is a genuine mathematical utility to these tools that physical cash and debit cards simply cannot replicate. Because you have to ask, why do highly affluent, highly financially literate individuals almost exclusively use credit cards?
Because of the asymmetrical leverage it provides the consumer, the text outlines 3 major defensive advantages, starting with online dispute security.
Let's contrast this directly with a debit card, just to be clear. If I buy a $1,000 laptop online with a debit card, and the merchant turns out to be a scammer who ships me a box of literal rocks, What is my recourse?
Your recourse is extremely limited. When you use that debit card, the $1,000 was instantly permanently drained from your personal checking account. Your liquidity is gone. You can call your bank and file a fraud claim, of course, but the bank is investigating the loss of your money.
Right, it's my problem.
Exactly. It might take weeks or even months to recover, and during that time, you are just out $1,000. Your rent check might bounce because that money is missing.
But if I buy that exact same laptop with a credit card,
The entire dynamic flips upside down. You use the bank's capital. When the box of rocks arrives, you log into the app and you initiate a chargeback. The credit card issuer immediately freezes that payment. You have not lost a single cent of your personal liquidity. Your rent money is perfectly safe.
wow.
More importantly, you have just weaponized the legal and financial weight of a multi-billion-dollar institution. The bank is now highly motivated to retrieve their money from the fraudulent merchant. They act as a massive, heavily armed shield between your checking account and the chaos of the open market.
That is an incredible paradigm shift. You are borrowing their leverage. And that applies to direct fraud as well, doesn't it? If a waiter skims your credit card number and runs up a $5,000 bill in some foreign country, you simply refuse the charges.
Exact.
By federal law in the U.S., your personal liability for fraudulent credit charges is legally capped at $50. And most major issuers will waive even that. Your actual cash sits safely behind a firewall.
It is the ultimate digital armor. The text also emphasizes the utility of the float we discussed earlier. That 30 to 50-day grace period is effectively a zero-interest liquidity bridge. If you experience a sudden, vital emergency, let's say a catastrophic plumbing failure in your home on a Tuesday, and you don't receive your paycheck until Friday,
A very common scenario.
very common, the credit card bridges that temporal gap. It provides immediate, critical access to capital without requiring you to liquidate long-term investments or ask family for money or secure a predatory payday loan.
But we also have to confront the shiny lure that gets everyone through the door in the first place. The rewards, the cashback, the airline miles, the hotel points. Because there is an entire subculture of consumers who claim they are, hacking the system to travel the world for free. What is the source text's ultimate verdict on rewards?
The text takes a highly pragmatic, deeply sober view of the rewards ecosystem. It does not deny that points have value. You can absolutely get free flights. However, it strips away the gamification and analyzes the underlying psychology. It warns that rewards are primarily operant conditioning. They are behavioral nudges.
Explain how that nudge actually alters consumer behavior in the real world. How does it trick us?
The primary goal of any rewards program is to incentivize frequency and volume of spending. The bank wants you to swipe more often to generate more of those invisible interchange fees from the merchants we talked about. But more insidiously, rewards completely distort the consumer's perception of value.
Okay, give me an example.
Say you were debating purchasing a $400 jacket that you do not strictly need. The rational, calculating part of your brain might say no, but the rewards program provides an irrational, highly compelling justification. Your brain says, well, I get 3% cash back on apparel categories, and I'm only 500 points away from a flight tier, so buying this jacket is actually a financially strategic move.
Which is mathematically absurd. I mean, you are not saving money. You are permanently surrendering $388 of personal liquidity just to acquire a $12 rebate.
Yeah.
You are spending real money to earn pennies.
Exactly. But it feels like winning. The bank happily issues these rebates because their actuarial tables prove that the gamification of points drastically increases the statistical probability that you will overspend, that you will stretch your liquidity, carry a balance, break the grace period, and activate the compounding interest engine.
It's bait.
It's highly engineered bait. The bank gladly gives you $50 in cash back this year because they know, statistically, it increases the odds you will pay them $500 in interest next year.
Which brings us to the absolute climax of the source material. If the system is rigged with psychological tripwires and devastating math, but simultaneously offers unparalleled fraud protection and free liquidity float, how does an individual actually safely navigate the machine?
That is the million-dollar question.
And the text answers it with the playbook of the smart user. It distills the behaviors of people who extract all the value from the architecture while paying exactly $0 in interest.
The playbook is fascinating because it is not a set of cute life hacks. It is a rigid, almost dogmatic financial philosophy. And rule number 1 requires a complete, uncompromising mindset shift. The The smart user treats the credit card as if it were a debit card attached to a locked vault.
Meaning they completely, totally reject the concept of the credit limit.
Entirely. They view the limit as a theoretical illusion. If they want to purchase a $300 item, they first verify they have $300 in fully cleared liquid cash sitting in their checking account right at that exact second.
So no floating on future income.
Never. They do not rely on a paycheck that is arriving next week. If the cash is not in the account today, the swipe does not happen. They are utilizing the card purely for the transactional firewall and the rewards, but the underlying capital is already perfectly secured.
Because they are setting themselves up for rule number 2, which is the non-negotiable law of the entire system. Always pay the statement balance in absolute full, days before the due date.
The smart user never, under any circumstances, carries a revolving balance. They never willingly break the grace period. In fact, they view paying credit card interest as an absolute failure of personal financial logistics.
But what about the monitoring aspect? Because we talked about how the physical abstraction of swiping a plastic card makes you, forget you're actually spending real money. How do they combat that psychological delay?
Rule number 3 addresses this directly through hypervigilance. Smart users do not wait for the end of the month to open an envelope and experience a panic attack over a massive number. They monitor their accounts constantly. They log into the banking app multiple times a week.
They force themselves to feel the friction.
Yes, that's exactly it. By actively tracking the rising balance on the screen, they artificially reintroduce the pain of spending. They keep the reality of their diminishing resources front and center in their prefrontal cortex, which completely neutralizes the bank's attempt to delay the psychological impact. And as a bonus, this constant monitoring allows them to spot fraudulent charges or merchant errors instantly, rather than weeks later.
And as we discussed with the algorithmic modeling, rule number 4 is proactive utilization management. They never let their reported balance cross that 30% threshold. They pay mid-month if necessary to ensure the credit bureaus only ever see a responsible, incredibly low-risk profile.
And finally, rule number 5 dictates their relationship with rewards. The smart user views cash back and points strictly as a serendipitous bonus. It is a secondary byproduct of a transaction they were already going to make with physical cash anyway. They never, ever allow the promise of a reward to act as the primary catalyst for a purchase.
It is a playbook built on extreme, almost robotic discipline. You are engaging with a highly volatile chemical reaction, extracting the heat and containing the explosion. The people who can maintain that discipline essentially get paid to use the safest payment mechanism on Earth.
Which highlights the great tragedy of the modern financial landscape, according to the text. The biggest mistake the average consumer makes is normalizing the debt. Because credit cards are so ubiquitous everywhere we look, society has just casually accepted carrying a balance as a standard, manageable part of adulthood. Everyone has credit card debt, people say.
Right. It's just treated as normal. But the math proves it is an absolute crisis. Due to daily compounding, unsecured credit card debt is one of the most toxic, wealth-destroying liabilities a human being can carry, short of a payday loan. I mean, even a small, quote-unquote, normalized balance left to compound will mutate into a massive anchor, dragging down your economic mobility for literally decades.
And this brings us to the final, unifying synthesis of the architecture of credit. The core philosophy the author leaves us with is profoundly empowering, but it demands absolute accountability.
Right.
The thesis is that credit cards are not dangerous. Ignorance of the architecture is dangerous.
The banks are not operating a malicious conspiracy against you. There is no shadowy cabal sitting in a boardroom trying to ruin your life specifically. They're simply operating a massive, highly optimized, totally agnostic mathematical machine.
It is a system built on explicit, legally defined rules. And like any system governed by pure logic, it brutally penalizes ignorance and it highly rewards knowledge. The deeper your understanding of the mechanics, the nuances of the grace period, the hidden nature of interchange fees, the algorithmic triggers of utilization ratios, the more leverage you extract.
Because ultimately, as the source concludes, modern financial stability isn't just about earning power. Earning is only half the equation. True stability is about managing the flow of capital, mastering the timing of your obligations, and making ruthlessly informed decisions. The credit card is the ultimate everyday stress test of a consumer's ability to manage that exact flow.
It separates those who understand leverage from those who are crushed by it.
It truly is a daily exam. Okay, as we wrap up this deep dive today, I want to leave you with a final thought to mull over. Something that builds on the architecture we've decoded today, but stretches into some fascinating, maybe slightly dangerous new territory. We know from the source text that credit cards are an immensely profitable cornerstone of global banking. We know the engine runs largely on the backs of consumers who failed the stress test, generating billions in compounding interest from revolving debt and billions more from the macro volume of late fees. But the text also gave us the playbook of the smart user, the disciplined individual who pays in full, never drops the grace period shield, and extracts the rewards. And the industry actually uses a fascinating, deeply telling piece of internal jargon for these perfect customers.
Oh, this is my favorite part.
They call them deadbeats. They call them deadbeats because they don't generate a single cent of interest revenue for the bank. So I want you to consider this hypothetical scenario. What would happen to the global financial ecosystem if, starting tomorrow morning, a massive wave of absolute financial literacy swept the globe? What if absolutely every single person on Earth read this text, mastered their psychology, followed the playbook flawlessly, and paid their balance in full, exactly on time, every single month?
A total cessation of the interest engine, just completely stopped.
Exactly. If that primary fuel source vanished overnight, would the credit card infrastructure survive purely on the invisible tax of those merchant discount fees? Or would the banks, suddenly starved of billions in compounding interest, be forced to completely tear down and rewrite the rules of credit entirely? I mean, would the interest-free grace period be eliminated? Would annual fees skyrocket to hundreds of dollars just for basic access? Next time you step up to a terminal and safely deploy that piece of plastic, take a moment to ponder the larger system. Ask yourself how your own daily financial discipline, whether you are acting as a deadbeat or a revolver, is actively interacting with, and perhaps quietly subsidizing, this massive invisible architecture holding up the modern economy.
It's a lot to think about.
It really is. Until next time, keep diving deep.